In your opinion, what is the benefit of having a trust?
Well, chiefly asset protection. There's a great deal of flexibility in using a trust where the wealth creator, generally the principal beneficiary, has an almost plenary power to distribute the largesse of the trust, profits, income, capital, to whomsoever in the family he chooses. And that's how we would like to see it, because many wealth creators see that wealth as theirs, loosely see that wealth as theirs, and they often draw no distinction between the trust that owns it and their own efforts in creating it. Not unnaturally. And therefore it fits nicely with the perceptions of the wealth creator to have that flexibility. For he sees, after all, it's mine, or at least it's the result of my labour. That's one benefit. The second benefit is stamp duty. If there's going to be property distributed within the family, that often happens where the wealth creator ages and he wants to start divesting assets to family members. There is no better way to do that from a stamp duty point of view than distribute it to members of the family group, tax-free. Stamp duty-free only, stamp duty tax.
So long as there's a beneficiary, in place, which there obviously will be,
yep,
the asset can be given to that beneficiary,
yes,
without stamp duty being incurred.
Yes, yes, if it's a member of the family group. And often that's what you do. It must be connected by consanguinity or affinity, so it doesn't have to be bloodline. So the family group is defined in that way. There will be capital gains tax, of course, on that distribution, but that's another matter.
Okay. But from an asset protection point of view, what are the advantages of the trust?
Protecting oneself against external creditors, contractual or tortious, that is, any civil wrongs as well as contracts, because so long as there's been no arm's length dealings between the trustee and the individual concerned, that is the principal beneficiary, then most likely that the assets of the trust will be as far as the risk goes if the debts incurred by the trustee are within power of the trust instrument. So the creditors will go after and be capped at and limited to the assets of the trust in competition with any other creditors, of course, but no further. If it were an individual, then there's an unlimited liability, not capped at any trust assets, but just on the lot. Okay.
On that, if you have, let's say, a corporate trustee that controls several trusts underneath it, and let's say each trust has a house within it, a property within it.
Yes.
If someone goes ahead, and let's say someone falls over, let's say you have 3 trusts, A, B, and C, and each one has a property in it.
Yes.
And someone goes ahead on property A and trips over and breaks their neck and sues.
Yes. The trustee.
The trustee. And sues the trustee for what's in that trust.
Occupies liability or something, yes. Okay. Yeah.
Can they access what's in that trust but no other trusts?
Correct.
Okay, so if you have several trusts and you split your assets up within those trusts,
yes,
basically any liability is quarantined within the trust that's been sued.
That's correct. What you have to be careful about is that there are no essential loans from one trust to another. If the trust being sued was owed a lot of money by another trust who might have funded the purchase of the property, for example, then the liquidator of the trust, of the trustee of the trust, the insolvent trust, would call up that debt and pass an insolvency along the line to whomsoever lent the money, or to whomsoever the money is owed. Now, in the case of one trustee, you technically can't lend to yourself as trustee, but in equity will treat that as a right to an accounting to adjust between trusts, so it's equivalent to a loan.
What about land tax? What about land tax and placing different properties in different trusts?
Yes.
Tell us a bit about that.
This is still alive and well. surprisingly. We do not in South Australia have a Land Tax Management Act the same way as other states do. And so that under the Land Tax Act, the aggregation principle, by which is meant a number of properties are added together as one to strike a land tax rate to each of those properties. So it's a system of striking a rate, tax rate, and it's very high in South Australia, very high. You can have some land tax savings by disaggregating. So what is said, the aggregation principle doesn't arise. So each is taxed singly on a rate governed by the value of that single holding. Now you do that through trusts. 13.3b of the Land Tax Act will allow that to happen. What you have to do is this: you must have discrete trusts, each possessed of one only or some only of the properties owned by the trustee, registered in the trustee's name. Ideally, one apiece, one property apiece. If the aggregate value is less than $1 million, there's some serious savings to be of land value, serious savings to be made by doing this. The land tax rates are so horrific. But you must give notice of the trust, each trust. I'll rephrase that. You must give notice of at least one trust to the Land Tax Commissioner, the Commissioner of Stamp Duties, by the end of June each year, or by the first end of June you pass, since ownership was established. And you must ensure that the trusts in question do not have the same beneficiary. If they have the same beneficiary, they can be added together as one to strike a common rate, the maximum rate, for all trusts, and so it's effectively aggregated for land tax. But if they don't have the same beneficiary, the Commissioner of State Taxes cannot aggregate them, but you must establish that each is owned by the trustee in a discrete trust capacity, by which I mean that one trust owns one property and none others. So if you do that, you can achieve the denial of the aggregation principle.
Okay, so that's land tax.
Mm-hmm.
What about other forms, I guess the other forms of tax? How does a trust help an investor, I guess, legally reduce their tax?
Yes. Income tax or stamp duty still?
Income tax.
Income tax, okay. Well, at the moment, and I say this advisedly, it's possible under our capital gains tax provisions for trusts to receive the benefit of the 50% discount, the general trust discount, general CGT discount, and pass it through to beneficiaries, non-corporate beneficiaries, who can themselves receive the benefit of that discount.
Now this discount only applies after a year of holding the asset?
Correct. Yes. All of what we're saying, I'm assuming that it's not trading stock or something that's acquired for resale at a profit. There's no discounts if that's the case. So if you own property and acquired it for capital purposes, you being the trustee, and the trust is a non-fixed trust, a hybrid or discretionary trust, then the distribution of the capital profit the trustee makes of the property is eligible to the discount at the trust level, but there's no tax there, passed down to the beneficiaries and through successive trusts.
Now it's at the discretion of the trustee, passed down through the beneficiaries.
Yes, generally so. We're talking non-fixed trusts.
Yep.
So it'll be the discretion of the trustee. If it passes through one or more non-fixed trusts, but not any trust with losses, that's where the buck stops. But if it passes down through one or more non-fixed trusts to natural people, natural person beneficiaries, then the 50% discount will be available to that beneficiary. What happens is grossed back up to 100% and then taken off that 50% each stage down, so that if the last stage is entitled to a discount, otherwise entitled to a discount, then the original 50% discount is allowed to him or her who receives it. That is something companies cannot do. There's no discounts, general discounts for companies. I mentioned in passing there's a general discount for super funds, and that's 33 1/3, not 50%. But it's unusual, not impossible, unusual for super funds to receive distributions from within a family through a trust. There are rules that treat that as non-arm's length income, or may in some cases treat that as non-arm's length income, not universally. And in that case, that's the discount where it applies, the discount is 1/3, not 50%. That's one big benefit of this. The next big benefit is where the trust carries on a business. And
so when we say a business, would this also apply to, let's say, assets within the trust that are positively geared, for example?
Yes.
So let's say, for example, you've had assets within a trust for 50 years, and the assets in the form of rent is making a $200,000 profit a year. This is the same as a business?
No. Okay. No, that's expressly excluded from the definition of active asset.
Okay.
And in any event, a profit derived from it will be from a pre-gains tax asset, so it's not going to be taxable anyway if it's owned 50 years.